back, ladies and gentlemen. Thank you all for joining me today. I'm excited to look at the Journal Technologies meeting. I've listened to it twice already, and that's over the last kind of month. And again, if you're not caught up on where I am, I'm catching up on all my stuff right now. So this is why this video is getting posted a month after this was actually released. So with that being said, I still wanted to learn and kind of show you what I'm learning, what I'm listening to, what I'm listening for. So with that being said, let's dive right into today's video, dive into Charlie Munger, see what he's got to tell us. I'm excited to take a look at what exactly he has. So I have on my second screen, I have obviously the main screen of the video, and then I have a second screen with the times. So you see me kind of looking over, that's why. But here you can see he's going to be talking about Journal Technologies. I'm playing this at 1.25. Hopefully it's not as slow as him talking in regular speed. So let's dive right into this.
Journal Technologies does. And so that's how we got together. The future of this business is not in the publishing side, it's on the Journal Technology side. And the good news is that we're in a huge market because all the courts of the world are in the Stone Age still in terms of automating with modern technology. And so it's a big market. And the bad news is it's a long, slow slog where you deal with a lot of bureaucracies in response to RFPs, requests for proposals. And
so I'm just going to take that piece, and I kind of wanted to open up with that because for some people who are looking at Journal Technologies, looking at Daily Journal, I think it's important to understand like kind of what this is actually going to look like. And he kind of goes on to say it's going to be a long slog. There's not something that's going to be quick. The request for proposals with dinosaur systems built into the governments right now, everything takes a long time. The bureaucracy behind everything, it takes like 5 to 7 years just to implement a system. So once they're in there, it's sticky and it's not going to get removed. But getting in there and actually creating those requests for proposals and doing all the work for it is really where it all comes from. But I just wanted to show you that he is very focused on Journal Technologies, and Stephen Myhill-Jones, the new CEO, or he's called interim, but really he can change that title once he decides to. But the new CEO has a background in technology. He had a startup that he sold, and he's back into this now. So I'm excited for what to kind of see what Stephen can actually do, what he can do as far as the Journal Technology side of the business, because again, that's where a lot of the opportunity is going to come from for Daily Journal going forward. So diving on over next, so that was the opportunity for Journal Technology. Next up, mental bias from Chat GPT was actually a question from Chat GPT. Thought it was really interesting. This one's going to be a little bit long, so bear with me. I'm not going to really talk too much on this, but it's exciting.
Someone named Peter Furlan wrote in from Oakville, Ontario, and he had a question that he asked Chat GPT to come up with a question to ask you, Charlie, and here's what Chat GPT came up with. Mr. Munger, you've spoken about the importance of avoiding mental biases in decision-making. In your experience, what's the most challenging bias to overcome, and how do you personally guard against it? So I'd ask your answer to that question, and then what you think of the question that Chat GPT wrote for you.
It's incredible that Chat GPT made
that. If I had to name one factor that dominates human bad decisions, it would be what I call denial. If the truth is unpleasant enough, people their mind plays tricks on them, and they think it isn't really happening. And of course that causes enormous destruction of business, where people go on throwing money into the way they used to do things, even though it isn't going to work at all well in the way the world is now, having changed. And if you want an example of how denial is affecting things, take the world of investment management. How many managers are going to beat the indexes, all costs considered?
I feel like he talks about this every single
I
time
would say
we have a meeting.
maybe 5% can consistently beat the averages. Everybody else is living in a state of extreme denial. They're used to charging big fees and so forth for stuff that isn't doing their clients any good. It's a deep moral depravity. If some widow comes to you with $500,000 and you charge her 1 point a year and you could put her in the indexes, but you need the 1 point. And so people just charge some widow, a considerable fee for worthless advice. And the whole profession is full of that kind of denial.
So this is something that I think Charlie, Warren, and a lot of other large value investors have stated, many times about the fees and how that really impacts people's performance, because you can earn 8% on a fund, but if the fund's charging you 1 or 2% of that money, you're really not earning 8%, you're earning 6%, 7%, whatever the math ends up being. So if you're going to invest in index funds, look at the expense ratio, look at the fee you're actually going to be paying, because that rebalancing and everything, when they get that money, you're not going to get that back. even though you may perform decently, 6 to 8% or whatever the index funds are performing, you want something with a really, really, really low fee, so that way you're not getting screwed when it comes to sort of, the end of your life, and you look back and you see how much money you could have had if you wouldn't have invested in such a high fee. But it's crazy to me that people will create index funds and then charge 1 to 2% still. And it's really because people don't know any better. So look into index funds, look at the Bogglehead Reddit if you're interested, but there's a lot of information out there. Don't just invest in the first thing that someone tells you to. So the next thing, it was kind of a question. I kind of jumped into the question rather than letting her ask. But the question really is about leverage and why he levered up on Baba and kind of what they did. So he kind of goes on to explain how they've used leverage in the past and things like that.
Horrible to do that. So you're right. It's unusual for us, but we did find a few things. And by the way, if you go back early in my career, I used some leverage. I sometimes ask myself a mental question. I say, what is the appropriate percentage of your net worth you should put it in a stock if you think it's an absolute cinch? Well, if you're the kind of fellow who's right and when you think something is a cinch, the answer is 100%, or maybe 150%. But nobody teaches people to think that way in finance. But if the opportunity is great enough, the logical answer is 100%, or maybe 200%.
Somebody else wrote in, and I don't have the email.
It's interesting to me to see that someone like Charlie, who talks about leverage and how not to use leverage, and that it's not good for you to use leverage, to talk about the fact that he actually did use leverage and they used margin on the company portfolio to buy Baba, and then they sold off part of the position. They did a lot of financial moves to get some more Baba but lower the cost basis and kind of keep everything the way it was. But they used margin. He used margin as part of that, which I think is really interesting because we talked about a lot, and just in general, about how margin is not good for the individual person to use, especially it's not worth blowing up your portfolio if you're, so dead set on a company. But, if your conviction is correct and you've been right before and you can see like the writing is on the wall, obviously within some risk management, but 100%, 150%, 200% of your money is actually an interesting thing to hear from Charlie. And I'm surprised that he stated it so simply, as well as saying that, Warren's done kind of the same thing in the past. It's not that surprising, but I would imagine that the odds of you finding a company where you feel that comfortable and you feel like it's a cinch is probably pretty small. It's one of those things like there's only a few opportunities where that probably comes up, and I think he felt Baba was that way. But it is interesting to see they still own Baba, I believe, on the portfolio. But to see him say this about leverage was pretty interesting. All right, so next up, a little question on China. What he thinks of it?
Just about China in general, I had a lot of questions that came in regarding that. I'll ask this one from Wilco Schutzendorf. It's coming in from Walnut Creek, California, who just said, previously you stated that despite certain shortcomings, China was generally moving in the right direction. However, with the recent actions taken by the Chinese government, such as capriciously punishing technology and educational companies, declining to import effective COVID vaccines, escalating threats towards Taiwan, do you still maintain that China is a viable investment option for foreign capital, or is China experiencing a similar regression as Russia has seen under Putin's leadership that culminates in the invasion of Taiwan?
Well, that's a very good question, of course, but I would argue that the chances in a big confrontation from China have gone down, not up, because of what happened in the Ukraine. I think that the Chinese leader is a very smart, practical person, and Russia went into the Ukraine because it looked like a cakewalk. I don't think Taiwan looks like such a cakewalk anymore. I think it's off the table in China for a long, long time. And I think that helps the prospects of investors who invest in China. And the other thing that helps in terms of the China prospects are that you can buy better, stronger companies at a cheaper valuation in China than you can in the United States. So you're getting the extra risk can be worth running given the extra value you get. That's why we're in China. It isn't like we prefer being in some foreign country. Of course, I'd rather be in Los Angeles right next to my house. It'd be more convenient.
This was actually really interesting to see such a big person and their take on China. And you're seeing this across a lot of different people in the value investing community as well as just the investing community in general, where it's not even just China. A lot of people are getting into other countries in the emerging markets and different kinds of financial markets as a way of A, there's better value, B, you can probably find companies that are equivalent to what we have here in the United States. They're not selling at a premium. They probably should be selling at a premium, but no one's found them yet, as well as the fact that there's not as many filings and regulations that they need to go through. Like, they don't have to file a 13F for foreign companies that they hold. Obviously, there's some other stuff on the background business side that they have to do, but there's nothing that goes out publicly that states, like, I own XYZ company. And this is why Munger and Lilu bought BYD way back when, and they held this company, and Munger actually convinced Warren to buy BYD for the Berkshire portfolio. And obviously it did really, 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 really well. And it's not surprising, though, when you find other companies in China, in India, in Turkey, and all these other countries where the opportunity is so great because there's no one looking. So you got to go where the fish are, but you don't want to be where a bunch of people are fishing. And that's kind of what's happening in the United States, is that everyone's looking now at United States companies, and they're overlooking a lot of the international emerging markets, especially because of the fact that the information just isn't necessarily there for all the companies, or there's fraud risk or other sorts of risk going into it. So it is interesting to see. I'm glad that he had mentioned how cheap China is getting, but taking a look going forward, we're going to kind of hop on over to some SBC talk.
All right, this next question comes from Karsten Fedorov, who's an equity analyst from Germany. And his question is, stock-based compensation is a popular means of incentive compensation in many companies. In some cases, these take on alarming proportions. It feels like companies are competing to outbid each other. In some companies, 20% of sales are paid out in stock-based compensation. How do you perceive this development in recent years, and what's a healthy level of incentives?
Well, I think you will find in American corporations very good incentive systems, and others that are too liberal, and others that are too niggardly. And what else would you expect of human nature but a certain amount of variety? And I agree that some of this, in many a corporation, everybody would vote to being allowed to have stock-based compensation. You didn't count it in computing the earnings. They just want any damn way of making the earnings appear higher. It's just human nature. Of course, they want it's like your little kid goes off to school, they want to bring in good grades, not bad grades. And so sure, there's a big problem of excess corporation pay in some places. Other places, like Costco, I would say the compensation system is damn near perfect.
He loves Costco.
And there's a fair amount of stock, but we always buy in enough stock in Costco to pay for the stock we're issuing. A lot of people in high tech, they issue the stock, and they don't buy it in, so it's a net dilution. I think there's a lot that's wrong in American compensation systems, but why wouldn't there be?
So this is kind of interesting to hear him talk about stock-based compensation, because obviously that's been kind of like a big conversation about the fact that you have all these new companies that came out over the last few years, or at least IPO'd, and they are using stock-based compensation as a way to pay their employees. But what happens is diluting the heck out of their current, stockholder base. And you have companies that either are issuing stock-based compensation to make sure that they can keep employees, or you have it where they're just issuing stock to be able to afford to run their business because they're running at such a huge loss. So it's not surprising to me to see him talk about stock-based compensation and have, kind of a nuanced answer on it. But I think when you're looking at your valuations and kind of going through the methods that you do to be able to look into a company, stock-based compensation should definitely be one of the top things that you're looking at, because if they're just diluting you as a shareholder, or they're buying back shares the same way that they're issuing it, I don't know, kind of rubs me the wrong way when companies do that, especially when they're just issuing shares just to issue shares. And they're not doing anything with that cash. I think if you have a cash flow positive business and they're issuing shares, it's maybe not as much of an issue because your earning per share is still growing. It may be getting a little bit smaller because of the dilution, but still growing. But to have a company that's completely negative and they're still issuing shares, that's where my issue starts with stock-based compensation. So the last question that I have here from Becky Quick to Charlie Munger was basically on how Warren's method changed and how Ben Graham's changed. And I feel like this was a great point to end this video on, so that's why I wanted to include it. But listen closely. I think it's really important to hear this because it kind of hits on the fact of, a lot of people think like I gotta keep getting these 100 baggers. But in reality, a lot of the times these companies are like once in a few times or even once in a lifetime kind of companies like Geico was for Ben Graham. So, listen to Charlie Munger talk about this and how Warren was impacted by this.
All right. Paul D. writes in, and I believe it's Paul Damakop, says, Charlie, you're largely credited with Warren Buffett's evolution to buying great businesses at a reasonable price, or in simple terms, a willingness to pay up for a great business. Given Ben Graham's exceptional insights and understanding of investing, how or why did he himself not evolve to foresee the inability to scale his net cigar butt approach? What do you attribute your early willingness to pay up stems from?
Well, remember, a lot of Ben Graham's rise in life was during a period when there was plenty of low-hanging fruit among mediocre businesses that were way too cheap. And he was relatively rare in doing his hunting in that garden. And so he made a pretty good living for himself buying these. What happened is that that low-hanging fruit eventually went away as the aftermath of the Great Depression went away. And Ben Graham actually made more than half of all the money he made in his life out of one stock. And that stock was Geico, which was a great business.
That's so crazy.
If you actually look at the great man's own life, you see that what he taught wasn't the way he got rich himself. And by the way, he told that story on himself late in life. He carefully computed how much he'd made in Geico compared to everything he had ever done in his previous life. And so you can argue that Ben Graham himself woke up once.
Isn't that crazy, though? I mean, I know the question was about Warren, but it's crazy to me that Warren and Ben Graham kind of had the same sort of thing happen to them, where you have one company that you just happen, you've been investing, and Berkshire actually, I know they say their holding period is forever, but they actually churn through a lot of companies and they only hold a few, which is not surprising given the management and how they run things. But when you look at Berkshire and what they have done, you can think of companies like Bank of America, Coca-Cola, and Apple are kind of like the big ones that have made a ton of money. And obviously there's been other companies that have made a ton of money in their portfolio for a lot of the other managers as well. But, kind of the big headline one that I think of is Apple and how big and how massive that position has gotten just over the last, decade or so, and what they've been able to do with that position and with the money that they made from that position. It makes up such a huge portion of their portfolio now. It is insane to me that, as a company that was able to happen, but, you look at Warren's life, you look at Ben Graham's life, you look at Charlie Munger's life, or a lot of the other big value investors, a lot of times there's 1, 2, 3, maybe a handful of companies that actually made up a lot of the growth that they saw. And for Ben Graham, it was Geico. For Warren, it was Geico. It was Coca-Cola. It was Apple, it was, Bank of America and a bunch of other companies. But it's crazy to me that this happens to them because they churn through a lot of companies, especially doing that net strategy. You're not really holding one company for a very long time, versus now you hold a wonderful company and you kind of let it ride. And that's kind of what Charlie did with Costco, and that's what Warren's done with a lot of his companies. So it's crazy to see, but it's a great lesson to learn and something to remember as you're going through your companies, going through your own due diligence, and trying to find your own portfolio and what matches for your own style. So with that being said, though, these were the findings I had from the Daily Journal meeting. I hope you liked it. I hope you really enjoyed. Let me know what you think of this format. I may do this a little bit more often if I have like longer form, interviews or whatever they want to watch, because I figured rather than like reading off what was actually being said, this was a way better way and kind of a little bit more entertaining way of going about it. But with that being said, thank you all for joining me today. Have a great day and happy investing.